Hello, this is Michelle McPhee at Life Benefits with how the insurance company charges interest on loans. When you pay your premium on a whole life insurance policy, your death benefit increases and so does your cash value that you have available to you for a loan. Now, when you take a loan, your death benefit is held as collateral for the loan and the insurance company loans you their money. They will charge you interest on that loan so that they will be able to meet the demands of the policy owners, that is, paying out death benefits. Now let's take a look at how they charge interest on loans and how you will be able to pay that interest.
You'll notice we have a calendar going across our screen, and up in the right-hand corner we have a birthday cake. Your date of birth becomes your birthday. It doesn't matter what day you want to celebrate it on it. The date of birth remains the same. When an insurance policy is issued, it has a policy issue date, and that is the anniversary date of your policy. Now, the anniversary date is important. It's when dividends are attributed to the policy, and it's also the date that they use to calculate when loan interest is due on an outstanding loan. Now, an insurance company there's two different ways that insurance companies charge loans. Some charge for interest on loans. Some charge the interest up front, and other companies charge loan interest in the rears. And it really makes no difference to the policyholder how they charge that interest, but we want to take a close look at that so that you have a little idea of what is happening. For our example today, we're going to have a policy issued on April 4th, and we're going to have our policy owner take a loan on June 4th. Now, the only reason I chose this is to match the April 4th. It's going to make it easier for our calculations, but I will tell you that the insurance company, it really doesn't matter when you take the loan. They have very sophisticated software where they're going to make loan calculations by the day, so it really makes no difference. In our example today, we're going to be taking a loan for $10,000. We're going to have the insurance company charging 5%, and so for a year of having a loan out, that would be $500. Now, in our particular example, you see we don't have a loan out for a year. We have it out for 10 months until the anniversary date. Now, that doesn't mean that your loan has to be paid off at the anniversary date. You can have this loan continue going. It's just that the interest that's due on this loan will be calculated by the anniversary date. So in 1 year, the payments would be $500, but we know that this is not 1 year, it's only 10 months. So we're going to divide this payment into 12 months to find out that we are paying about $41.66 of interest to the insurance company per month, and over 10 months that's going to be a calculation of about $416.60 for interest. So let's look what happens when we take a loan. Let's go up to the insurance company and let's have a loan of $10,000. Now, if the insurance company is charging the interest upfront, then they are going to actually make this loan for $10,416.60. That will be the loan balance at the insurance company when we request the $10,000. For the company that charges the policy loan interest in the rears, the balance with the insurance company is going to remain at $10,000, and they are going to charge us at the anniversary date $416.60 for that 10 months that we had that outstanding loan out. Now and that's if we paid nothing back to the insurance company, but that's not our plan. We are planning to make loan repayments, so let's look and see what that looks like. We're going to take this $10,000 loan, we're going to loan it to the money manager's account, and then we're going to send it over to our personal. From there, we're going to go buy $10,000 worth of goods and services. We have an income coming in, helping us to make a loan repayment. We're going to make it to our money manager's account and then to the insurance company. When the insurance company sees this amount come in, the company that charged you upfront realizes that they now charged you too much interest because you don't have $10,000 out for a whole 10 months. So now when this payment of $500 comes back in, they're going to have to adjust this $416.60. They're going to credit back some of that interest to you. Now, if you make this $500 loan repayment to a company that charges in the rears, they are also going to note that date very specifically, and then they're going to adjust what amount of interest they charge you down here. So let's look at how we're going to pay that loan interest. If we are making a annual, semi-annual, or quarterly premium payment to the insurance company, then for the anniversary date, we're going to receive a statement. And on that statement, they're going to tell us what premium is due, and then also what loan interest is due. And if we are paying on a monthly basis, then we will receive a statement just for that loan interest that's due. Oops. Okay. And so let's look at the case of the company charging up front. Well, they already charged for 10 months of interest. Let's say we paid nothing back to the policy. So we're going to go back up here. Our loan balance is still $10,416.60. And on $10,000, we know that that would be $500 that we would have to pay for the following month. But now we see it's $10,416.60. So the amount that we've got to pay is going to be more like $521, and it will be due at this time. For the other insurance company, we know that they're still just charging us that $416.60. This is when it is due. Now, how are we going to pay that interest? Going to change pen colors here. When you were making your loan repayments, you kept putting that $500 in here. Let's say you did that 10 times. So now you've paid in a total of $5,000, and let's just roughly do calculations, and let's use this 10,000 amount so it's easier. We can say now that the insurance company only has an outstanding loan of $5,000. So the insurance company that charges up front, they're going to charge you interest on this $5,000. It's going to be about $250. The company that charges you in the rears is going to be adjusting this amount. It's going to be, I'm not sure what that amount is going to be. They're going to make the calculation. And what you can do now is either pay this amount from your personal account to the insurance company, because you have these two options. You can either do that, and that will be just like some extra savings you did out of pocket. Or you can say, no, when I was making these payments, I was really doing it to pay principal and interest. And so when they send you this bill for the $250, you can just ignore it, knowing that if you don't pay it, they're just going to increase the amount that you have in your outstanding loan with them. So they're going to then, if they don't receive the payment by your anniversary date, then they are going to just say, oh, okay, now you owe $5,250. And it's just reattributing the payment you already made back in a different way. And so that takes care of it. There's nothing extra out of pocket for you. Now I want to go over to the, in the advanced loan repayment, we did not do the step of paying the insurance company back. So let's talk about how you're going to pay your interest. You didn't pay it back because you were going to be using these funds more rapidly. And so you'll remember that I talked to you about setting this $500 aside because you knew that you would have it due. Well, if the company charges the loan interest in the rears, you're going to definitely have that money right there. Now, if they're charging it up front, you're going to see that it's just a little bit more than that $521, and you had a lot of money flowing in and out of this account, so you will probably have that money to take care of that $521.